In the first 6 months of this year, the helicopter industry has continued to face difficulties. Over the next couple of minutes, I will provide a brief snapshot of what we've observed and how ultimately it has affected values. At the start of Q2 2020, the oil industry faced two major problems: the COVID-19 outbreak and the OPEC war. The combination of the two events pushed oil prices to the lowest levels on record. In an attempt to recover oil prices, OPEC members agreed a reduction in production at the same time as COVID-19 caused a significant decrease in overall demand for oil. The result was a reduction of active oil rigs, which can be seen here in the chart. This has a direct impact on the use of offshore helicopters and increased oversupply in the sector. Unsurprisingly, it's the helicopters heavily exposed to the offshore sector that has seen the largest reduction in values in this mid-year review. In the parapublic sector, such as EMS and SAR, helicopter played a pivotal role in the management of COVID-19 outbreak by moving patients to and in between hospitals. At the same time as the large parts of the world was in lockdown, there were lower incidents requiring the services traditionally provided by these machines. Overall, values remained stable for this sector. In the last 6 months, the H225 has started to show signs of recovery, 4 years after the fatal accident in Norway and subsequent grounding. It has found a market within utility and heavy lift missions. Values increased in the first value move for the asset since values were reinstated in October 2018. Whilst this helicopter is unlikely to return in an offshore capacity, it has the potential in search and rescue. Now let's have a more detailed look at value movements. The value changes in the charts will show the percentage value movement to the half-life market values for basic passenger utility configurations. Fluctuations in other configurations will vary. I have divided the content up in two groups covering medium twins and super mediums and heavies. Firstly, let's look at the medium twins. The S76 is continuing to struggle to find the sizable secondary market, although we have seen the value difference between corporate and offshore configured machines reduce. This follows some demand from the corporate sector as a result of low values. The AW139 has been reduced as the gap between short nose and long nose examples continue. The short nose variant, produced between 2004 and 2008, is taking the brunt of the reductions. Meanwhile, the Bell 412EP continued to move into utility missions. Moving on to the super mediums and the heavies. The super mediums are struggling to gain any significant market share, and order books are declining just 7 years after the first machine was introduced. In the heavy category and the S92, there was a glimmer of green shoots at the beginning of 2020, which appeared favourable, but events this year changed that. Demand is low and storage rates are around 15%. Some motivated transactions of bank-owned assets to lesser milestone at very low values have been observed. Lease rates, however, appear stable. As a result, values have reduced up to 20%, with the older vintages seeing the highest reductions. There are shortages of heavy SAR machines, but reconfigurations for offshore S92s to SAR comes at a very high cost and is very time-consuming, so it's unlikely to impact the surplus of offshore machines. As previously mentioned, we have noticed signs of recovery for the H225. Half-life market values for the type in utility configuration has increased from 3.4 million to 6 million. Overall, transactions in H1 2020 were reduced, whilst availability appeared to be increasing. Such demand-supply dynamics does not help values, and further value fluctuations will depend on the speed of recovery. The team here at Descend by Sirium continues to monitor developments in the helicopter space closely, and as always, we welcome your comments. Thank you very much for listening.